Hi there, welcome to the Open right here on BNN Bloomberg. Big day for central bank decisions. Desjardins thinks the Bank of Canada is perhaps being too alarmist about inflation, says it seems to be under control. We're going to have lots about that, but let's get to the other big stories we're bringing you from the BNN Bloomberg newsroom. Amazon is cutting about 16,000 jobs as the tech giant continues to streamline operations amid rising adoption of artificial intelligence. Those eliminations take Amazon's announced job cuts to 30,000 in 3 months after an initial wave in October. Last year, employees were warned that AI will shrink the workforce as Amazon operates more of its business. Or automates, more of its business. Shares in CGI moved up in the pre-market. That's after the Quebec-based provider of IT services posted higher first quarter profit, and revenue was boosted by demand for AI-related work. The giant IT consulting firm says the quarter shows that clients are still spending on modernization and outsourced IT work. The company said this week it's expanding its partnership with OpenAI. CGI stock, though, as of today, down almost 30% in the past year. Eli Lilly has struck a deal with a German biotech called Seamless Therapeutics, valued at $1.1 billion US, to develop gene therapies for hearing loss. The U.S. company will get an exclusive license to use the technology to develop experimental drugs. Gene therapy has become a key interest area for the drug maker. About a third of Lilly's pipeline is now genetic medicines, most of which are still in the early stages of development. U.S. stocks closed at a record high, and it looks yesterday, and it looks like the S&P 500 is going to push further into a record territory. Let's check out how the TSX traded yesterday. It's still slightly down from its record high, but not by much. And let's have a look at gold. Gold has just stunned market participants with its exponential rise. It's in record territory again today. Part of gold's massive increase over the past year has been a drop in the US dollar. The US dollar this week hit a 4-year low against major rival currencies. And did we look at oil? I always skip over crude. Let me have a look. Okay, so oil moving up. It's interesting. The Saudis have apparently indicated to the US, we're not willing to act as a base for any attacks on Iran. And let's have a look at the Canadian dollar, which has been strong amid this US dollar weakness. And it's up again, almost 74 cents US. And finally, Bitcoin, the biggest cryptocurrency. Well, let's see how it's faring. And it is holding in today and actually has moved above that 90,000 psychological mark. The Bank of Canada and the U.S. Federal Reserve are set to announce their first interest rate decisions of 2026 today. We get word from the Bank of Canada at 9:45 a.m. We're joined now by Carl Shimoda, Chief Market Strategist at Corpay. Carl, thank you very much indeed for joining us.
Good morning, Andy.
Desjardins making the case today that there's really no evidence right now of underlying price pressures. Inflation seems to be under control in Canada at barely above 2%.
Yes, that makes sense. So I haven't actually read the research yet. I definitely do make a point of reading anything that Randall writes, so I'll definitely jump on that. But definitely when we look at the inflationary backdrop in Canada, the broader context is that it is not demand driven. In other words, whatever price increases we are seeing are largely coming from the supply side of the economy. So what the Bank of Canada tends to work on is, whether consumers have the wherewithal to spend and whether they're, increasing demand over time. That is not the case. So, from a monetary policy standpoint, it makes sense at this point to stay on hold, to leave policy settings where they are, and to continue to hold sort of a dovish bias in the event that we do see some of these broader uncertainties feed through into economic underperformance in Canada.
Yeah, the piece I'm actually reading is by Royce Mendes of Desjardins, but we always do love hearing from Randall Bartlett as well. Just a quote from Desjardins again, very briefly. Sure, there was lots of fiscal stimulus announced in the budget, spending, but Desjardins warning that a lot of this is not going to really have an effect until perhaps late 2026.
That's right. And, the great part about this is that we have recent experience to tell us that, right? We did see a large number of fiscal announcements coming under the last government, under Trudeau, and it took years for those to show up in the bottom line, if they ever showed up at all. So, it does not make sense at this point to be making policy on the expectation that we're going to see a sudden surge in demand coming from, a increase in public spending.
You're seeing plenty of signs of softness in the Canadian economy. Obviously, that's a big factor for the Bank of Canada. This is interesting. You reckon that output is being propped up almost entirely by exports and not domestic demand?
That's right. The downturn in the housing market in Canada that has, played out over the last year and a half, I think that's probably the biggest factor in leading to underperformance in Canada. But as well, we've had this huge shock of trade uncertainty, policy uncertainty that has weighed on business hiring, that has impacted how consumers spend, and that is leading to very, very weak demand at an underlying level across the Canadian economy. And so, unfortunately, that's being somewhat obscured by the fact that exports have held up, and a large part of that has to do with tariff front running as opposed to really strength and underlying global demand. And so I think at this point, your bias certainly has to be toward continued weakness in the Canadian economy, as opposed to a sudden overheat of the type that might require the bank to step in with a rate hike at some point.
When we compare the benchmark rates in America and Canada, certainly Canada's been far more aggressive with attempting to stimulate the economy over the past couple of years with lower rates.
That's right. And it did come off the starting block faster than the U.S. And so I do think that is helping to put a floor under the Canadian economy. But, it does mean that U.S. rates have further to come down. And that is part of why we're seeing the U.S. dollar underperforming its global counterparts and underperforming the Canadian dollar in specific right now.
Does it mean, so we're looking at the target rate for the U.S. Federal Reserve. Of course, we get their decision today. Just on the U.S. dollar, President Trump, always hard to read what that Delphic oracle has to say, but he seems happy with, doesn't seem too concerned about this slide in the U.S. currency.
No, and I do like that you use the term Delphic Oracle there, because there's been some research in recent years showing that the Delphic oracles were essentially contaminated by drugs. They were on drugs all the time in the cave in which they occupied. Yes. So yeah, they made some pretty random statements. We see some pretty random statements out of Mr. Trump. But I do think that what we saw yesterday and on Friday is extremely important. So, on Friday we had rumors that the U.S. Treasury was working with its Japanese counterparts to potentially intervene in currency markets, which would mean sort of a concerted effort to raise the value of the yen and depreciate the value of the U.S. dollar. So the last time that we really saw something like that was back in 1985 after the Plaza Accord. And then last night we had Mr. Trump saying, you know, I can make the dollar go up and down like a yo-yo. He literally did say that. And that, you know, he thinks the dollar's doing great in the fact that it is weakened. So, you know, it does look as if this administration has abandoned the strong dollar policy that was sort of a hallmark of previous administrations going back to the 90s. It does look as if they're trying to engineer a depreciation. And, you know, quite frankly, I think this is the biggest story in global markets, bar none, at this point.
Oh, that's interesting. We'll have to keep we'll have to get look into this more, Carl. Thanks for the heads up. Can we just finish with something? The Wall Street Journal claims today that China is in a deflationary doom loop. Always good to get the word doom into a headline. What do you think? Are they looking at radical, dangerous overproduction in their economy and weak domestic demand?
Oh, yeah, they have been for quite a long time. I think we started warning about it maybe 4 or 5 years ago. And the main reason is that you have the housing market continuing to underperform. So, you know, the price of homes is going down over time. That's weakening, you know, the spending power of households and weighing on sentiment. And then at the same time, the government's stimulus push has gone almost entirely into supporting businesses in producing more goods. And so this has led to a situation in which, you know, whether they're making profit or not, businesses are pumping out a lot of goods, a lot of services. Those are depressing prices in China, and then China's exporting those imbalances to the rest of the world. And so, yes, you know, unless something changes here, we are looking at a dislocation that comes from a drop in prices in China itself.
You know, Delphic Oracles, I'm thinking about Zack Snyder's movie from 2006, 300, and there was rather a salacious portrayal of the Delphic Oracle in that one. Thank you very much. And now I've got to watch it again. It's one of my favorite films of all time. Carl,
I can't watch it because everybody has much better abs than I have. So, you know, I'm never going to watch that thing again.
What do you mean? Oh, better abs. Oh, yeah, that's right. Yeah, Gerard Butler and his physique. Yeah, it's a bit depressing.
Yeah.
Carl, thank you very much indeed. Carl Shimada, Chief Market Strategist at Corpay. Coming up, the Prime Minister is not backing down from his speech in Davos, despite pushback from the Trump administration. Carney says, I meant what I said. Mark Carney won praise in many quarters with his speech at the World Economic Forum in Davos. Of course, he warned of powerful nations pushing smaller countries around, using, for example, tariffs or economic pressure as a weapon. The Trump administration, or an insider there, has said or claimed that the Prime Minister aggressively walked back some of his remarks in a phone call with the US President. Let's get more from CTV's senior political correspondent, Mike LeCouture, on this war of words.
I meant what I said in Davos.
Prime Minister Mark Carney stood by his speech during a phone call with U.S. President Donald Trump. The 30-minute conversation covered Arctic security, Venezuela, and Canada's agreement with China.
I explained to him what we're doing, 12 new deals on 4 continents in 6 months. He was impressed. And that what we intend to do going forward, as well as the opportunity to, of course, move forward on CUSMA.
Let's talk about the Prime Minister, or if you prefer, Governor of Canada.
12 hours earlier, the U.S. Treasury Secretary says he was on that call and characterized the conversation differently.
He spoke to Prime Minister Carney, who was very aggressively walking back some of the unfortunate remarks he made at Davos.
Asked specifically about that.
So you didn't walk back your comments?
No.
But there was no public readout of the conversation between Trump and Carney, something the Conservatives are criticizing. Michael Chong wrote on social media, it is unacceptable that Canadians and journalists learned of this recent call from American media. Besson's comments come days after Trump threatened to impose 100% tariffs on Canada if the government signs a free trade agreement with China, something Carney says he's not pursuing. Political analysts believe the current strategy is to keep calm.
Trump is going to make noise. He's going to flash. He's going to swear. He's going to stamp his feet. Just take a breath, take a moment. Chances are the storm will pass, and it has.
The Prime Minister says he reiterated in his conversation with the President that Canada is responding to the change in U.S. trade policy by building new partnerships abroad, including with China. And Carney says Trump understood that. Mike Lecouteur, CTV News, Ottawa.
Up next, we'll check out the markets and we'll look at some stocks on the move. Let's have a look at stocks around the world. We'll start off with Asian markets. You can see the Nikkei up marginally, the Hang Seng jumping, the CSI, the big Chinese blue chip index, pretty flat. Just to repeat that the Wall Street Journal claims that China is in a deflationary doom loop. It's addicted to exports. That's not a new story, but there's just too much domestic production. And the Journal says that if you go to Shanghai's largest clothing market, the vendors, they're not making sales, they're processing returns. So it sounds like these Chinese economic challenges aren't going away. Moving over to Europe, the Dutch chip equipment maker ASML surged on stronger than expected earnings and optimistic guidance. And now this is Europe's most valuable company. And it was up something. Well, we'll have a look at the stock in a minute, I hope. ASML shares, though, that Dutch company, doubling over the past 12 months. The company booked orders equivalent to about $16 billion US in its latest quarter. And that was pretty well double a year ago. Thanks, Control Room. There's a look at ASML stock in the pre-market. They specialize in extreme ultraviolet lithography systems. And these are fancy machines that let chip makers print incredibly intricate layers on semiconductors. That's how the Wall Street Journal explains it. Let's have a look at U.S. futures, because it looks as though we will get the S&P 500 opening in record territory this morning. Sorry, U.S. stocks closed at an all-time, the S&P 500 closed at an all-time high yesterday. And let's have a look at the TSX, which is trading near record highs. It edged higher yesterday by about 0.01%. Okay, so the Federal Reserve, like the Bank of Canada, is expected to maintain its benchmark interest rate today, but it's likely that the chair, Jay Powell, will be questioned about a legal case against him. We heard from Dennis Lockhart, American economist and former CEO of the Federal Reserve Bank of Atlanta.
I think they signaled in December that they're comfortable with the positioning of policy, probably for a few meetings even. They feel that they can wait and see how the economy evolves and obviously follow inflation as well as employment very closely. So I'd be very surprised if there was a further policy action tomorrow.
Do you feel that labor concerns have been put to rest, at least for now?
I'm sorry, I didn't get the question.
Do you feel labor concerns have been put to rest, at least for now?
Major concerns.
Labor concerns, labor concerns.
Labor concerns?
Yes.
I think the labor market is fairly static at the moment. Unemployment is at an acceptable level of 4.4%. It's been slowing in terms of job creation. Much of that job creation has been in healthcare. But at the same time, it's not unraveling. It's not falling apart. And people are basically maintaining their employment. Claims are low. So I think the overall assessment is the employment market is sufficiently healthy to go on hold for this meeting at least, and perhaps more.
What about inflation? Do you feel that inflation is in a range now where Americans aren't feeling too much pressure for prices?
No, I would not say that.
Okay.
We do have sort of a split economy. That's a bit simplistic, but split between affluent households and those households that are struggling month to month to get by, and that's a big portion of the population in the United States. And those people are feeling the cost of living and feeling the cost, particularly of housing and groceries. So it's not necessarily a let's just say a single picture. The U.S. consumer continues to be quite active, and the consumer economy is going well. But I would not say that people can ignore the inflation rate that they're experiencing personally.
What about the threat of the government shutdown? What is your best guess on if one can be avoided, and how do you think that'll factor in later in the year, if there is one?
Well, I'm not following the play-by-play on Capitol Hill on this, but it is looming as a possibility. One recent article said it could be a partial shutdown, not a complete shutdown. We'll see how it plays out. But let me answer your question by saying it is one more factor in the first quarter of this year that will make it difficult, I think, for economists and for Fed staff to really evaluate the underlying strength of the first quarter economy. The first quarter is often a little bit odd because of weather and what they call residual seasonality. But if you add the possible shutdown to that, you could have a first quarter like last year that's weak, but then it's followed by strong quarters afterwards. So it's one more reason why I think the committee will be patient for a while before making any further policy decisions.
What commentary are you going to be listening for when you anticipate that there won't be a cut? What are you going to listen for from the chairman?
Well, the chairman's in all likelihood going to get a number of questions in the press conference about the Department of Justice investigation, maybe about the Lisa Cook proceedings at the Supreme Court last week. I think he's going to try his best to evade all those questions and say very little. And as regards the economy and policy, again, I'm not sure the committee is going to have a great deal to say. This could be, in some respects, a sort of boring meeting from the point of view of the public's public communication, because they are unlikely to cut rates. They're probably going to describe the economy as continuous with the fourth quarter of last year and reinforce the wait-and-see message. So I think there is not a great deal to say, and I wouldn't be surprised if that's the outcome tomorrow.
We've got those opening bells coming up on Bay Street and Wall Street. And there you have it, the opening bells at the NASDAQ. Adamas Trust is doing the honors. At the NYSE, it's the woman herself, Melania Trump, ringing the opening bell. It's time for the first 15. Let's check in on the equity market. Of course, the S&P 500 is in focus here. Now, it's up, so it must be at a new record high, slightly down from the pre-market level, and the TSX higher as well. Few stocks that we're interested in today. Andy Willis in the Globe, always well informed, is talking about potential takeovers in the gold industry after the Probe Gold a while ago, and of course this week Allied Gold. And he says analysts are highlighting potential mid-tier gold companies that could attract bids, including Skeena Resources and also Seabridge Gold. Skeena has a market cap of about $5 billion. Seabridge Gold, maybe $4.7 billion. Gold, of course, well, look at those stocks. Seabridge is up almost threefold in the past 12 years, or what am I saying, 1 year. Let's have a look at CGI, and it's higher. That stock has sagged, though, over the past year. As of this morning, it was down about 27% in 12 months. Desjardins has a buy and says cash flow was robust during the quarter, and says that these results should be taken in the context of the valuation on the stock, which sits near a 10-year low, except if you leave out a brief period during the pandemic. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Thanks very much, Jeff. Seagate, the data storage company, rising?
Seagate is one of the top performing stocks in the S&P 500, and so is another company called F5. Both of these are kind of in that hardware, technology, and equipment companies, and it's part of a kind of a broader move higher this morning that we're seeing, not only from these two stocks, but a handful of others. In Europe, ASML was one of the top performing stocks after similarly robust robust guidance and better than expected earnings. So kind of all across the space this morning, we are seeing a number of big moves higher. As you mentioned, Seagate Technology currently almost at the very top of the S&P 500, F5 not far behind it. The whole space getting a great big lift, and it's worth watching the NASDAQ 100, which is really weighted and heavily weighted towards those technology companies this morning. I'm looking at my screen; it's 0.8% higher for the NASDAQ 100. So these tech companies are really providing a boost this morning as we're into earnings season and into the heart of tech earnings season.
Starbucks, what's happening there?
Yeah, Starbucks is rallying this morning. It is also among the top performing stocks. It's hard to keep up with those tech companies, but it's among the top performing stocks this morning. It moved sharply higher in the pre-market session. What has happened here is the guidance for the company. The investors have been looking for a turnaround story from Starbucks since a new CEO took over, and they think that in the guidance outlook that they have this morning, it may finally be here. So Starbucks sees 3% sales growth over the course of the year. Wall Street had expected only 2.8%. Vital Knowledge out this morning with a note saying that the margins are not especially noteworthy, nothing really kind of under the hood that looks phenomenal here. But again, investors have been looking for a turnaround, and this may be it. At least that's the view right now on the street, and apparently in the stock market. Stock is one of the top performing in the S&P 500 so far.
And more job cuts at Amazon.
Yeah, Amazon also moving higher this morning. Definitely worth watching over the course of the session. So they're cutting 16,000 positions. This is not only something that's worth watching at Amazon here because the stock is moving higher, but we are really into the heart of this earnings season, and into the heart of the part of the earnings season where we see the mega cap tech names begin to report results and come out with some guidance. So Amazon is in focus this morning. It's cutting 16,000 jobs and moving higher. After market close tonight, we have 3 mega cap tech names that are reporting: Microsoft, Meta, and Tesla, all worth watching after the close. Apple is coming tomorrow, and the other 2 Magnificent 7 names are expected next week. So a lot happening in the mega cap tech space this morning. Definitely all of these stocks worth watching over the course of the trading session.
Amazon apparently has something like 1.6 million employees worldwide. So it's just maybe too big. Is it too powerful? I guess we'll leave that for the antitrust people. Thanks very much indeed, Jeff. Jeff Morgan of Bloomberg. Coming up, what to watch out for in those big tech earnings that Jeff Morgan mentioned. We are looking out for results from Meta, Microsoft, and Tesla. Stick with us. Later today, we're going to get results from some tech giants, Meta, Microsoft, and Tesla. Now, all of them are off their recent record highs. So what should investors look out for? Let's bring in Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Great to see you once again. Thanks very much indeed for joining us.
Morning.
Give us your thoughts on Meta. It's planning enormous spending on AI computing. Some investors may have misgivings. It's a bit like the story we saw with the virtual world Zuckerberg was so crazy about. What is your view on Meta?
Well, it's funny you bring up the metaverse, and of course they had that big rebrand. They actually in 2025 wound down all spending for the metaverse segment. So I really think the pressure is on Meta to show these AI-based revenue streams in comparison to the spending that they're putting out, and I think that'll drive a lot towards if the stock can push higher. But you mentioned it yourself. I think that this is a big week for AI earnings generally. And Intel should serve a warning from last week to what investors can maybe expect if earnings don't meet expectations for all of these stocks.
Let's put up a 1 year for Intel, because there was some euphoria about Intel, Nvidia buying into the company, the US government doing so, and progress slower than a lot of Intel investors had hoped for.
Yeah, I mean, I think investor reactions to these earnings beats or misses will be very telling about sentiment for the space overall. And as we know, given the concentration in the U.S. markets in particular, these companies will not only be a big week for their own stocks, it'll be a big week for the overall direction of the market. I think one of or a few of the headlines that I've seen over the past couple of weeks and really in 2025 was that Sell America trade. And really for me, I look at it a different way because I don't think that the American economy is crashing or inflation is going to run away. I think it's more about investors are selling what's expensive and they're moving to geographies and other areas of the market that are more reasonably priced, and from a risk and return perspective, they look at more favorably. And that doesn't just mean they're selling America outright. That means that there's other areas of that market that maybe there's more of interest for investors, because I do think that there is such a need to be highly selective in the names and the investments that we're making today.
You have some stock ideas for us. Wendy's, where do you see the attraction here? I guess we've heard yada yada, lower income consumers under pressure in America. Is that going to be a headwind for them?
Yeah, well, it was a headwind in 2025. There was all the talk about the K-shaped recovery and how the bottom cohort of consumers were not spending quite as much. I think that 2026 will see some stabilization in that respect. Trump's tax bill kicks into effect in the spring. That'll offer some fiscal support for consumers in this segment. And then also you have the anticipated greater foot traffic of the World Cup coming to Canada, the US, and Mexico, which should offer some stabilization as well and some positivity. I think overall, not only for Wendy's, but the quick service and fast casual dining space generally, I think that there's an opportunity there. Sentiment is quite poor, and Wendy's in particular, they announced a turnaround plan to modernize and improve restaurants. They've only put that out in their corporately owned locations today, but they've seen some positive indications, and Wendy's, they're trading at the lowest valuation they have in over a decade, and you're getting almost a 7% yield today. So I think that there is some room for some multiple expansion from here.
Exchange Income Corporation, EIF, in Toronto. Just remind us what they do and why you see this stock as a potentially good buy.
So Exchange Income Corp, I've talked about them on the show before. They are a business that they invest in companies with strong cash flows in particularly niche markets. And they're interesting because they're actually the leading transport provider in Northern Canada. And they're deemed an essential service, which reduces some of the cyclicality that maybe some of the other airlines face. They also have pilot training schools, medevac services. They have a business that does aerial surveillance with some big contracts in the UK and in Australia. Really conservative balance sheet, really well-run business that have compounded returns for shareholders over the last 20 years, over 20%. Estimates for 2026 are favorable, but they don't assume any M&A or major new contracts, which could offer some additional upside for the shares from here. It's not as much the yield play that it maybe was at the start of last year, but it's a company that we continue to really like.
And then finally, a company, RBC Bearings, its symbol is RBC, not in New York, nothing to do with Royal Bank, though.
No, it's its own entity. So they're an aerospace and defense stock. They make highly specialized products that are used in nuclear submarines, jet airplanes. Boeing and Airbus are two of their biggest customers. 90% of their revenues are in the U.S., so they're seen as being a real benefit to some of that defense spending in the U.S. and the national security mantra that the Trump administration is putting out. Boeing and Airbus have been ramping up production. We saw Boeing's earnings earlier this week and their delivery expectations for 2026 and 2027, which sets up RBC really well, and they've got some really great pricing with those contracts. And the company backlog, just from the defense side of things, went from $825 million last year to over $2 billion today, entering 2026. So a lot of room for them to grow. I think management has been very good at expanding margins and making some very accretive acquisitions. They bought Vaco Industries in late 2025 to expand their product lineup, and their earnings are coming in higher.
We better go. Thank you very much indeed, Kyle. Great hearing from you as ever. Kyle Taylor, Wealth Advisor and Portfolio Manager at TriDelta Private Wealth. Coming up, the Bank of Canada makes its first interest rate announcement of the year. We're standing by for that first interest rate announcement of the year from the Bank of Canada. Bay Street's been betting on the bank standing still, and sure enough, they are. They're holding the policy rate at 2.25%, matching estimates, and they're keeping the target range at 2.25%. So I'm not seeing any huge surprises here. Let's get more from Earl Davos, one of our favorites when it comes to monetary policy, head of fixed income and money markets at BMO Global Asset Management. There's the Canadian dollar. It was already strong this morning, so
yes,
we'll keep checking in on it. You're in the camp, and Carl Shamala told us this earlier as well. You broadly agree that our domestic economy is weak, but we're being held up by exports, partly because the American economy is doing fine.
Yes, that's exactly it. And the way to look at that is when you look at the water of the oceans, you have the tides and the waves. Canada's the waves. Our domestic economy is the waves, and those waves are very low right now. But the tide is rising. That's the U.S. economy. And that has had surprisingly strong growth because of the easy financial conditions over there, arguably stimulative monetary policy at the same time. And the tax returns now are coming back in, that big, beautiful bill.
Yes.
U.S. economy continues to outperform, showing significant real growth and nominal growth. And that helps Canada because despite all the noise and everything that's going on, they still account for like 60% plus of our exports.
And a huge chunk of our economy is that we have such an open economy.
Yeah. Exactly.
The governor, Tiff Macklem, saying we're going through this structural adjustment right now. What does he mean by that?
What he means by that is no matter how much he lowers interest rates, it's not going to impact jobs. And the reason why it won't impact jobs is because we're not putting shovels in the ground right now. He lowers interest rate, we're not putting more shovels in the ground. Yes, Prime Minister Carney is working on policy and stuff to start changing that, to put more shovels in the ground, in addition to Premier Ford. But that's a 5 to 10 year story.
Yeah.
So what are you going to do now? So that structural change, he can't impact. What's interesting, though, in the U.S., they're experiencing structural change as well. AI, that's not going to change lowering interest rates, but they still have an easing bias and going to lower interest rates. Why is that? The reason why Bank of Canada focuses on inflation first, employment second, but lowering interest rates has an impact on the psyche and the psychology of the market. It makes people more willing to spend out there, maybe for quantitative reasons, maybe their line of credit or HELOCs or whatnot. That interest rate goes lower, it's cheaper to borrow. But also when interest rates are lower, you have more money in your pocket, you feel more likely to spend. So from a psychological perspective, it makes sense to lower interest rates a bit more, but based off economics, on hold's the right call.
The problem seems to be, though, one reason to cut rates is to encourage businesses to invest, or we just can't seem to crack that problem. Canadian firms not investing.
Yeah, I would say so. There's two things related to that. So we can't crack the problem because we don't understand CUSMA yet. It's being renegotiated. That is the economics of doing business, of cracking here. Because when businesses put shovels in the ground to build out industry, They're doing it both from the perspective of Canadian consumer, but they're also looking at it from the American consumer because we're so close, and you don't know the cross-border economics yet. So once that's settled, lower interest rates will help. There's another way how lower interest rates, however, could help as well. Lower interest rates here in Canada, especially when it's not expected, actually weakens the Canadian currency.
Right.
So right now we've seen strength in the Canadian currency over the past 2 weeks. That's, yes, related to U.S. dollar weakness, but nonetheless, we are significantly stronger, as strong as we've been in possibly almost a year on the Canadian dollar. That's not helpful for attracting international money to invest here because Canada is becoming more expensive. When the Bank of Canada eases interest rates, the interest rate differential between Canada and U.S. has a direct impact on the currency. It actually weakens our currency relative to the U.S. That might be a consideration going forward as well, too.
Why shouldn't the Bank of Canada just cut already then? Drive our currency down, make our exports competitive?
So from that business perspective, yes. So the question is, why are they not cutting? They're worried about inflation. So when and how are they worried about inflation comes across? They cut, weaker dollar means higher cost of goods.
Imports.
They cut, more people are buying when the economy's, we're not in recession. We still have positive growth.
Right.
So when you cut in that environment, it may stoke some inflationary winds. And core inflation is still around 3%. Their target's 2%. That is the reason why they're worried, because we're above the target for inflation. On the margin, they don't want to push it a bit higher. So that's why they're on hold right now.
Macklem, in his statement today, says economic growth likely stalled in the fourth quarter in Canada.
Yeah, I could see that. That's a possibility. You kind of see it in the unemployment numbers. They ticked up a little bit. The business outlook survey, that's a very important thing that the Bank of Canada looks like. The businesses aren't as confident right now. So it's possible it's stalled. Having said that, growth right now in the U.S. is staying very high. And again, we come back to the original point. That will have a positive implications on Canadian growth for the first quarter, at least. So I wouldn't say it's stalled, but I wouldn't say it's gone negative.
No.
I wouldn't say it's declined. And stalled is not declined. Stalled is stay there. Muddling along used to be a phrase that was used to see. That's part of our underlying thesis, trading thesis, investment thesis for 2026, was that Canadian growth would significantly underperform U.S., but it would still be positive. One of the other things that's interesting from a Canadian perspective is obviously this commodity rise, significant commodity rise. We are a commodity-based country as well. That increases the potential amount of investment that could come into Canada from, reopening mines, expanding mines, the critical earth, gold, silver. We have everything here in Canada. That's a positive. But again, that's a medium to long-term story. It takes a while for that to show up in GDP.
And isn't there a problem with that? Commodity prices go up, and then that just brings on more supply worldwide.
Yes, possibly. But what's interesting about the market right now, we spoke about structural change. We're possibly undergoing some significant structural change in the commodity world. And what do I mean by that? Given how we're seeing the fragmentation of the world, as Prime Minister Carney spoke about, different sort of blocks and stuff.
Yeah.
Individual countries right now may want to store their own commodities. They may want to build oil storage. They may want to do it. We saw it in China. They've been way ahead on this, the wheat storage, the oil storage, just so they're not dependent on the rest of the world.
Yeah.
And I think that independence, or that need to be self-sustaining, is increasing, which puts a demand for commodity, makes it still cyclical, but could have this as an extended trend. It could be a multi-year effect in regards to commodity prices staying high or going higher.
That's interesting. Well, we've heard about that, a balkanization of the world commodity market.
Yes, exactly that.
Yeah.
It's exactly that. And the environment is primed for that to happen. And that's a long-term story. And another very interesting thing about, just not a commodity thing, but interesting thing about commodities when you look at it, that significant rise in gold and silver especially, what happens when you get a significant rise in silver, it usually expands into all commodities for a while. Why? Because silver is actually a store of wealth. You use it to purchase things. Now, wheat, oil, almost all commodities are the cheapest they've been in decades if bought with silver because of the rapid rise. So what happens? People who have silver now start converting that into the other commodities. A very interesting thing about the commodity world. The reason why I'm so detailed on this, in my former world, I used to be the head inflation and real rate trader at one of the pension plans.
Yeah.
And I had to know commodities, inflation inside out. And these are one of the things where it becomes a virtuous cycle and could be extended. So this is in the back of my mind from a bond investor perspective, that inflation could rear its head again because all this shows up in prices, but that's not a story right now. That's a story for 2027 and beyond.
And just tell us a bit more about the role of silver. I didn't know it was so important.
Yeah, silver is and becoming increasingly important. So silver has let's go back to gold first. When people look at gold, it's a store of wealth. It's used basically as for purchasing power,
right,
and to maintain real wealth. Silver has two things going for it. One is it has that store of wealth, especially when the price is so much cheaper than gold per ounce. Like it prices itself out. You think of India, the biggest retail investors not investors, buyers, because they buy it for jewelry.
Yes.
In the world.
Yes.
They've been converting to silver as well too, just because the price per ounce is so much lower and it's increasing. It's becoming reinforcing. So you have silver as that store of wealth as well, but it's also an industrial metal. And it's used significantly in electricity and building up grids and whatnot. And we see that the whole grid needs to be redone in North America. So there's demand there, increasing retail demand, but it's also a store of wealth. And when converted into other commodities, all the commodities look cheap. This is when you start seeing people going out of silver into the other commodities. It's a broadening of that boom, which from a bond investor's perspective, again, is in the back of my mind, but not a story for today.
I just wonder, though, the government has their national projects and there are things like LNG and copper. Well, that's great, but why don't we have more companies like ASML, a Dutch company, because it sells stuff regardless almost of price. You can't get those lithography machines from anybody but ASML.
Yeah. And I think that's the next evolution. So, I think another way to rephrase exactly what you just said, we need to refine the stuff that we're taking out of the ground. Get the value add, sell the value add products in addition to just the commodities. And I think opening up the borders in the next few years is a way of the future, and that's the path to exactly what you just mentioned.
Well, I think we have to leave it there, but I could talk to you all day about this. Earl, I think you're going to stick with us for a little bit longer. I'm glad to hear that. Thank you very much. Okay, we're going to be back with Earl Davos. He is head of fixed income and money markets at BMO Global Asset Management. We're going to take a quick break. We'll bring you the headlines and another look at the markets, and then Earl Davos. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Eli Lilly has struck a deal with the German biotech Seamless Therapeutics. It's valued at $1.1 billion US, and the idea is developing gene therapies for hearing loss. The U.S. company will get exclusive license to use the technology to develop experimental drugs. Gene therapy has become a key interest area for Lilly. About a third of its pipeline is now genetic medicines, most of which are still at the early stage of development. Shares in Starbucks climbing. That coffee giant topped expectations on global sales. They were up 4% at established locations. The American company also issued its first full-year outlook with sales from established locations forecasted to grow at least 3% in 2026. This is part, of course, of CEO Brian Niccol's turnaround efforts. Starbucks has focused on improving service and reducing menu complexity since 2024. Amazon is cutting about 16,000 jobs as the tech giant continues to streamline operations amid rising adoption of AI. Amazon says these latest cuts at Amazon announced job cuts to 30,000 in 3 months after an initial wave in October. Last year, employees were warned that AI will shrink the workforce as Amazon automates operations. And here's a look at the TSX. It is up in early trading. Interestingly, helped once again by gold, and it's hitting a record high. The price of gold, the spot price of gold, keeps climbing to record after record. And let me give you the spot price. I'm seeing $5,295. So we're at, on the spot price, almost $5,300, a new record for spot gold. And let's have a look at the U.S. markets here. S&P 500 is higher. It closed at a record high yesterday, so sure enough, it's hitting a new record high right now. And let's have a look at gold. We will look at the futures. I think we're into the April futures right now, sure enough. And they are in record territory too. Wow, look at that, well north of 5,300. And finally, let's have a look at the Canadian dollar in the wake of the Bank of Canada decision to leave rates unchanged. And there are signals from US President Donald Trump that he's fine with the drop in the US currency. Bank of Canada has announced that it's leaving interest rates unchanged, even though the governor, Tiff Macklem, says there may have been no growth in the economy in the fourth quarter. We're joined now by our own Lindsay Biscaya. Lindsay.
Yeah, and Andy, this really isn't a surprise. The fact that the Bank of Canada has decided to leave rates unchanged. In the latest survey from Bloomberg, which surveyed 28 different economists, all 28 said that they expected this to happen today. Now, in a statement from Tiff Macklem, the governor of the Bank of Canada, he says we're going through a structural adjustment, meaning once again, no matter how much he lowers interest rates, it's kind of out of the Bank of Canada's hands at this point, and there needs to be other factors at play to really help stimulate the economy. I know you're speaking with Earl Davis today, and you guys had a really interesting conversation just moments ago talking about any plans by the federal government to kind of boost the economy, put more money back into the pockets of Canadians or boost jobs. It's going to take a while before we see the effects of that. We know that the federal government just this week announced a GST rebate boost on groceries, but something like that, we probably won't see the effects until the end of 2026, therefore meaning we're not going to see that public spending until the end of 2026. So again, that's not really expected to help the economy either. But this year, the year-on-year inflation pace ticked up in December to 2.4%. Inflation still around 3%. That's just above the Bank of Canada's target of 2%. So again, we're hearing Tiff Macklem today say that rates, for now at least, will remain unchanged. And we'll have to wait to hear more from the governor of the Bank of Canada at about 10:45 today.
Thanks a million, Lindsay. Lindsay Biscaya. Earl Davis is back, head of fixed income and money markets at BMO Global Asset Management. Thanks so much for sticking with us. You've had a couple of minutes to look at commentary from the Bank of Canada. Anything jumping out for you, Earl?
No, nothing jumping out. Largely that they were, well, maybe there's one thing that's jumping out, that they maintain that they could either ease or hike rates going forward, just depending on how Kuzma unfolds. If it's smoother than expected, there may be a little bit of stimulus in the market. But if it's not, unemployment rises, then there may be room to lower. One interesting thing about our outlook for the Bank of Canada, so the market itself is saying unchanged, maybe a few chances, a small chance of an ease by the summer, but it's also saying there's a small chance of a hike by the end of the year. Ourselves, we were in the camp that we would think there's going to be 1 to 2 more eases by the end of the year. What's interesting, that changed a little bit in the past week. We now think there'll be 1 ease, not 1 to 2. Why? The GST rebate. That's actually
Oh.
very stimulative to the economy. That's almost like an ease. It puts more money in the pocket. People spend more. So that's almost the equivalent in our minds of an ease. So the Bank of Canada may be thinking about that as well, saying, okay, we're comfortable, we're even more comfortable being on neutral right now. But for us, we still anticipate one more ease by the end of the year, which is a change from 1 to 2.
It's interesting, of course, it's going to go to moderate and lower income Canadians.
Yes.
I mean, 12 million people affected is about more than a quarter of the population.
And not only that, there's another thing with that. Because it's going to low to moderate income Canadians, they have a higher propensity to spend.
Right.
You give it to higher income Canadians, that might go in the bank.
Yeah.
And so that is the inflationary stimulative part on the economy.
That's interesting. Yeah. So Carney may have done some of Tim Macklем's job for him here.
Most definitely. It does take off the some of the pressure off of in the short term.
Yeah.
In the short term.
It's interesting, though, referring to the potential for a hike. Of course, central banks always like to keep a baton kind of, behind their back, saying we're willing to bring out the stick if people get too euphoric.
Yes. We just don't see the reason for that. What are the possible things that could lead to the hike? A rise in housing prices, which we don't see happening this year. It's probably going to stay more neutral. That increase in housing prices is probably a 2027 story. Unemployment rate goes down to below 6.5%. Right now, it's ticking up to 6.8. We believe. So, what's a trigger for an ease?
Or for a hike?
No, for an ease. We'll say a hike. For a hike, I just spoke to the triggers for the hikes. Unemployment rate going below 6.5, better than expected Kuzma, resilience, and the like. What's the trigger for eases now? I think the number one thing is it's a combination of two things. Unemployment rate goes above 7%, and there's job losses. Why do I put those two things together? There's two ways the unemployment rate could go above 7%, just people losing their jobs and they're more unemployed. The other way it could go up is there's still an increase in jobs, but there's more people re-entering the job force. That's not as negative because there's an increase in jobs, disposable income in the aggregates going higher, so that's not as fun. But if we see unemployment rate above 7% and a loss in jobs during 2026, net loss, that to me is a big trigger for an ease.
I suppose the ratcheting back of immigration and cuts in the number of temporary workers in Canada, that's broadly going to inflate wage growth, isn't it?
Yes. And so let's talk to your point. Inflation is wage growth because you're looking for more employees to work those jobs. So you have to pay them more if you're not getting them.
And the supply of workers.
And the supply of workers. Having said that, we are having more people re-enter the force who were on the sidelines. So that could take over some of the slack. So don't see that being as big an impact. What you're saying is very true for the U.S. It's a significant impact in the U.S.
The cutback in immigration.
Yes, just because of the amount of immigrants or non-documented individuals living in the U.S. working in the agricultural industry. It is significant, and that could have a significant effect there on wages and or inflation.
I wonder, are some immigrants, legal or not, just dropping out of the labor force because they're scared of being arrested if they're out on the street?
You're definitely seeing that. You're seeing that, in the U.S. when you have raids on Walmarts and all these things, surprise wages. You could see that, the fear, the reconsideration of their status and what they want to do.
Just on monetary policy, let's leave out politics and prosecutions and stuff. What's on Jay Powell's mind right now?
Jay Powell's in a very tough position. And the reason why he's in a very tough position, it's very hard not only to justify eases, or let me put this, it's becoming increasingly hard not only to justify further eases, but even to justify the overnight rate at levels at which it's at now.
It's stimulative?
Oh, yes, it's stimulative. And you're seeing that now in the growth effect. You're having almost 4.5% real growth, which is 7% nominal. So how do you create, and there's three things behind that. So better financial conditions, it's easier to borrow money, and stimulative fiscal policy, still running deficits, that's money going to the economy. You could add in now tax stimulus coming in this year. A lot of those tax breaks of the big, beautiful bill are taking effect right now. And ultimately, right now, monetary policy. Do you need 5 level or 4 levels of stimulus right now? That's becoming increasingly hard to argue. So it'll be interesting to see the press conference, how he tempers that, because he definitely is going to maintain an easing bias, without a doubt. So we'll see how the market takes that.
So if we just look at the narrowing U.S. deficit and strong U.S. GDP growth, can President Trump claim to have done well on the economy?
Oh, yes, he can right now. But again, we're talking, there's 3 levels. There's short term, so short term, yes. Medium term, let's call it 2 to 5 years, unknown. 10 years plus, the bond markets will let you know if he's successful. Right now, he's successful. Bond yields haven't moved to new highs. We haven't tested the highs of last year. So as long as bond yields stay in the range of 2025, he could claim success.
And of course, that one risk he faces is the return of the so-called bond vigilantes who will punish the U.S. over the growing deficit.
Yes, but they're busy in other markets right now. Japan. Japan seeing the highest long-term yields we've seen in decades. Oh, yes. So they're busy over in Japan. But yes, that does have influence on yields here. And that is a risk. And having said that, the Treasury has said we'll fight the bond vigilantes as hard as possible. We could do QE, we could do whatever. So bond vigilantes, stay out of the U.S. So we'll see.
And just remind us, why have Japanese bond yields gone up so much?
The new prime minister that came in fall, she is a spender, fiscal stimulus. And they're also now, the inflation is at the higher end of their range. So they've been hiking rates as well. And it's just a fiscal stimulus, significant fiscal stimulus. There's another election coming up in about a month where if she wins again, which she's anticipating, that's why she called such a quick election in February, there'll be even more fiscal stimulus. And that's what people are worried about in Japan, about all this fiscal stimulus. Will they be able to pay me back my money in 30 years, the printing of money? So that's why it's going up. And they were the lowest long-term yields in the world for a very long time because of QE over there.
Decades.
Yes,
Decades.
Yes.
Earl, thank you very much.
You're most welcome.
Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Up next, so the Bank of Canada standing pat on interest rates. What about the impact on mortgages, particularly variable rate loans? We'll have that when we come back. So the Bank of Canada is standing steady on its key interest rate at 2.25%. We have seen a marginal rise in inflation, but unemployment was also up in December. Policymakers said back in October that borrowing costs were at about the right level to support growth while keeping inflation near the 2% target. And we're also, of course, later today going to get an interest rate announcement from the Federal Reserve. Let's check out shares in CGI, the giant provider of ET services based in Quebec. Governments around the world are a major customer for them. And they also, of course, they say that they're getting a boost here from more and more artificial intelligence work. You can see the stock actually down, hitting a new multi-year low, as is today a CSU, Constellation Software, and Thomson Reuters. And those are old line data bank software companies that investors fear will be hurt by AI. Let's get back to the Bank of Canada standing pat on interest rates. Our guest is a mortgage broker. He says this news will be disappointing for millions of Canadians with variable mortgage rates and home equity lines of credit, as they are priced off the Bank of Canada interest rate policy, often linked to the prime rate. We're joined now by Ron Butler, mortgage broker at Butler Mortgage. Ron, thanks very much. Just remind us, I know it's hard to get specific figures, but are variable rate mortgages, just to narrow in on them, are they a huge portion of the mortgage market still?
Yeah, they make up about 30% of the entire mortgage market. So those variable rate mortgage holders have been crossing their fingers, hoping for more cuts. And unfortunately, today it did not come through.
And can you just remind us, have rates, with the cut in interest rates, variable rates have come down over the past year?
Yeah, variable rates came down significantly in 2024 and 2025. And as you know, the pause, Tiff Macklem, the Bank of Canada governor's pause, started in November, and it continues now.
Do you think Tiff Macklem pays much attention to variable rates and variable rates on home equity lines of credit? Is it a big consideration for the Bank of Canada when they think about interest rate changes?
I think they consider it, but they consider it in a very small way. Their belief is they've come down from the high of 2023. They've come down 50% from the high. So in their way of thinking, they've done a pretty good job of getting those rates down. 2.25 is the bottom of the bank's neutral rate. So they feel that they are not harming variable rate holders by being in this range. So it enters their consideration, but it's nowhere near a big factor.
You think people should think about perhaps locking in a fixed mortgage rate? I mean, what can people typically get on a 5-year mortgage right now?
They're all hovering, a 5-year fixed rate is all hovering around the 4% range. It might be a terrific deal like 3.89, it might be 4.09, it might be 4.19, but right around the 4% range is what most people can get a 5-year fixed for today.
And of course, that to a large extent hangs off the 10-year bond yield or the 5-year bond yield. Maybe we could put up a 5-year chart for the old 10-year Canadian bond yield. Broadly, do you think that's going to be as good as it gets on a fixed rate mortgage over the next couple of years?
Well, I think so. But you can't be sure.
No.
I'm an old man. I'm 68. I've been doing this for 30. I'm old. I've been doing this for 30 years. And I can't really remember a more volatile time in geopolitics, in the financial world. If you can imagine, we got to spend some time in the mortgage business thinking about the Japanese bond market.
Yeah.
So that tells you just how volatile this really is.
And there's been that stunning change. That's interesting. So the government, essentially, if it was to issue new bonds right now, they'd be paying just under 3% on a 5-year term, in theory anyway. But a 5-year mortgage will cost you about 4%. Is that a big spread, Ron? Are mortgages expensive in relation to bond yields, or can you generalize?
I can generally tell you that these spreads have narrowed consistently over the last 5 or 6 years. When I was first started in the business, banks were looking for about 125 spread. It seems today they're comfortable with the 1% spread. There's just added competitiveness. I know that sometimes Canadians don't think that since we have fewer banks than the U.S., we're not very competitive on some products and rates. But I can tell you that these banks are very, very sharp competitors in mortgage world.
It's interesting. I do remember years ago, there used to be mortgage funds, mutual funds in Canada. This is going back a long time. But the banks stopped offering them because it was such a juicy business. They wanted to keep it all for themselves.
That's about the best way to describe it, yes.
Because it's stable. People will do virtually anything to be kicked out of their home. And the banks don't want to even do that either.
No, they don't. Banks we have experienced an increase in mortgage default rates in the last year. If you go back to 2021, it was the very bottom. There was only 12 basis points of 90-day default in Canada, which is a perishingly tiny number. But it's gone back up to 24 basis points, and most banks expect us to hit the more traditional 32, 34 basis point default rate within the next year. So default rates continue to rise. It's a difficult time in the real estate business in Ontario and British Columbia. Home values are down, home values continue to fall, and that puts some people in a precarious position.
And that's not just an oversupply of condos, it's generally true of home prices?
Well, I read today that we are almost, and we might be in it, we have almost gone full circle back to 2019 in Ontario house prices. Now, Ottawa's still fairly strong, but all through Southern Ontario, we're actually almost touching 2019 prices for homes, which is a big round trip. It's an incredible round trip from 2021, all-time highs, March 2022 in Ontario. And it hasn't stopped falling yet. So we have a lot to observe in the coming months.
Well, of course, the federal government has been mocked for mumbling when asked, do you want home prices to drop? And of course, observers say, well, if you want housing to be affordable, you need home prices to drop.
Yeah, Gregor Robertson's the federal housing minister's famous comment was, we will achieve affordability, but we want all Canadians to maintain the value of their homes, that's an interesting idea for sure. Yeah, that was interesting.
Ron, can I ask you to just comment on politics here? And you may want to avoid this one, but is that going to be trouble for the Ontario Conservatives if the public get ticked off with falling home prices?
I think the public understands that the provincial government has no control over home prices. I think almost everyone understands that. So I don't think that will be a major issue in any future election in Ontario, but it is definitely a factor that will make people in Ontario a little bit more unhappy with their financial situation.
Ron, always great talking to you, and thank you very much indeed.
Thanks again.
Ron Butler, mortgage broker at Butler Mortgage. Coming up, today's ETF report, and we're putting the spotlight on XGD, an ETF that tracks gold mining stocks, and it's been on fire lately. ETF report today focusing on just one of the gold ETFs that's out there, XGD. Now, traditionally, or certainly in recent years, there's been a fear that when gold goes up, gold executives will get too euphoric because, of course, automatically a higher gold price makes more of their reserves economically viable on paper anyway. So in the past, we have sometimes seen investors wary of buying gold stocks when gold is strong. But there's a look at XGD, which it tracks global gold stocks. We'll have a look at the big holdings. It's actually interesting. Newmont, the US-based company, topping the holdings at last time I saw the numbers, yes, 16%. Agnico comes in at 12%, and then Barrick at 10%. Barrick stock has been rallying sharply. Wheaton is interesting, 8%. Remember, I mentioned yesterday, RBC estimates that a huge chunk of their revenue, I think it's their revenue at current silver prices, comes from silver. So obviously that's attractive. And Wheaton Precious Metals, its origins were in silver streaming. And then Goldfields coming up at number 3 there. Let's put up a comparative chart for XGD versus the actual gold price. And look at that. Over 1 year, XGD has blown away the price of gold. Now, the price of gold, my assumption there is we're showing it in US dollars. So there is a bit of a currency factor here. But look there for quite a while, the gold stocks were, as measured by XGD, underperforming the gold price. That was the case through 2023, right into 2025. But late in 2025, look how the actual gold stocks exploded. So that's an interesting trend that people, even with gold getting to record highs, people are piling into the gold equities. We've also got Franco-Nevada at a big holding. Okay, right. Let's get over to the Bank of Canada press conference.
Oh, good morning, everyone. Bonjour tout le monde. Bienvenue à la Banque du Canada. Welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement and our monetary policy report. Le gouverneur Macklem va prononcer une déclaration préliminaire et ensuite on va tourner aux questions des médias. After his opening remarks, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions until about 11:15 or so. Mais pour commencer, Monsieur le Gouverneur, à vous la parole.
Thank you, Paul. Good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our decision and monetary policy report. Today, Governing Council maintained our policy interest rate at 2.25%. Our forecast for economic growth and inflation in Canada has not changed significantly since our October projection. As the Canadian economy continues to adjust to U.S. trade restrictions, we expect the economy to grow modestly and inflation to stay close to our 2% target. However, uncertainty around our forecast is heightened. The range of possible outcomes is wider than usual. U.S. trade policy remains unpredictable, and geopolitical risks are elevated. Our monetary policy decisions are focused on keeping inflation close to the 2% target while helping the economy through this period of structural change. Governing Council judges the current policy rate remains appropriate, conditional on the economy evolving broadly in line with the outlook we published today. With heightened uncertainty, we are monitoring risks closely. If the outlook changes, we are prepared to respond. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,25%. Notre prévision pour la croissance et l'inflation au Canada n'a pas beaucoup changé depuis la projection d'octobre. Alors que l'économie canadienne continue de s'ajuster aux restrictions commerciales américaines, on pense que la croissance du PIB sera modeste et que l'inflation va rester près de la cible de 2%.
And we will remain at 2%.
Une incertitude accrue pèse
Cannot
sur
hear
notre prévision. Il y a plus de
volume
résultats
too low.
possibles que d'habitude.
There are more possible
La
results.
politique commerciale des États-Unis
The
reste
commercial policy of the
imprévisible
U.S.
et
remains
les risques
unpredictable,
géopolitiques sont élevés.
and the
Nos décisions
political
de politique
restrictions are high.
monétaire
Our
visent à maintenir
decision
l'inflation près
focuses
de
on
la cible
maintaining
de 2%,
inflation
tout en
close to
aidant
the 2%
l'économie
target,
à
while
traverser cette
helping the
période de
economy
changement
to get through
structurel.
this period of change.
Le Conseil de direction estime que le taux
The
directeur actuel demeure
Governor's
approprié
Council
à
thinks
condition
that
que
the
l'économie
rate is currently
évolue de
appropriate
manière
as long as
généralement
the
conforme aux
as the
perspectives
economy
publiées.
continues based on the perspectives published
Comme
today.
l'incertitude est accrue,
Since
on
uncertainty
surveille
is
les risques
increased,
de près.
we
Si,
monitor the risks
si nos perspectives
close,
changent, on
and
est
if our
prêt
perspectives
à réagir.
changed, we are ready to react.
So let me expand on what we've seen in the economy since October and what we see ahead. Tariffs and uncertainty continue to disrupt the Canadian economy. After a strong third quarter, economic growth likely stalled in the fourth quarter. Exports continue to be buffeted by U.S. tariffs, while domestic demand appears to be picking up. Household spending is expected to continue growing moderately, supported by past cuts in interest rates and rising disposable incomes. U.S. tariffs and related uncertainty have held back business investment, but we expect some modest strengthening in investment as businesses adjust to the new trade environment and governments increase infrastructure spending. The impact of U.S. tariffs can also be seen in the labor market. Employment weakened in the first half of 2025 as sectors hit hard by U.S. tariffs cut production and jobs. In recent months, overall employment has risen, led by hiring in services like healthcare. At the same time, slowing population growth is reducing the number of new entrants into the labor market. Still, the unemployment rate remains high at 6.8%. Youth unemployment is particularly elevated, and relatively few businesses say they plan to hire more workers in coming months. Overall, economic growth is expected to pick up gradually. The Bank of Canada projects annual average GDP growth of 1.1% in 2026 and 1.5% in 2027. broadly in line with our October projection. Turning to inflation, it averaged 2.1% last year and has now been within the 1 to 3% band for 2 years. If we focus on recent movements, CPI inflation rose to 2.4% in December, boosted by base year effects linked to last year's GST HST holiday. The bank's preferred measures of core inflation have eased from 3% in October to around 2.5% in December. The bank expects CPI inflation to stay close to the 2% target over the projection, as tariff-related cost pressures are offset by excess supply. Uncertainty around this projection is unusually high. Geopolitical risks are elevated, and the upcoming review of the Canada-US-Mexico agreement is an important risk to the outlook. It's also still too early to tell how the Canadian economy will adjust to current tariffs and ongoing uncertainty. The transition to the new trade environment could be smoother than we expect, with stronger business and household spending. Alternatively, the labor market could weaken further as trade impacts deepen, leading to lower household spending. And financial conditions could also tighten if volatility returns to markets. Considering both our baseline forecast and the risks, the Governing Council discussed a future path of monetary policy. While Council judges the current policy rate is appropriate based on our outlook, the consensus was that elevated uncertainty makes it difficult to predict the timing or direction of the next change in the policy interest rate. So let me wrap up. L'économie canadienne s'ajuste au vent contraire de nature structurelle liée au protectionnisme américain. Les entreprises réorganisent les chaînes d'approvisionnement et investissent dans de nouveaux marchés. On s'attend aussi à une réaffectation de capitaux et de main-d'œuvre quand de nouvelles possibilités vont ouvrir. Ces changements, qui comprennent des échanges plus diversifiés et une meilleure intégration des marchés internes, vont favoriser une certaine relance de notre capacité de production. Ça va prendre du temps. La politique monétaire ne peut pas compenser les dommages structurels causés par les droits de douane, ni cibler les secteurs de l'économie durement touchés. Mais elle peut apporter un soutien en aidant l'économie à traverser cette période de changement structurel, tout en maintenant l'inflation
close to the 2% target.
La banque s'engage à préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversement mondiaux. The Canadian economy is adjusting to the structural headwinds of U.S. protectionism. Businesses are reconfiguring supply chains and investing in new markets. We also expect to see some reallocation of capital and workers as new opportunities open up. This restructuring, including diversifying trade and a more integrated internal market, will support some recovery in our productive capacity. But it will take some time. Monetary policy cannot compensate for the structural damage caused by tariffs, and it can't target hard-hit sectors of the economy. But it can play a supporting role, helping the economy through this period of structural adjustment, while maintaining inflation close to the 2% target. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. We will go to those questions now, starting with reporters here in the room in Ottawa. Then we'll go to those who joined remotely. As usual, I'm going to ask you to limit yourself to one question so we've got time to get to every outlet. If I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait. Et comme d'habitude, libre à vous de poser vos questions soit en français ou soit en anglais. We will start with a question here in Ottawa. I'm going to start on the left-hand side of the room as I'm looking at it, then work our way to the right. So let's start with Paul Vieira from the Wall Street Journal, please.
Governor, is the Bank of Canada saying that the outcome of the USMCA negotiations is going to dictate the next move in interest rates?
Paul, what we are saying is that uncertainty around our forecast is unusually high. There are a number of risks and uncertainties. Geopolitical risks, geopolitical uncertainties have increased, they're heightened. U.S. trade policy remains highly unpredictable. And for Canada, yes, CUSMA, what happens, what the outcome is of the review of CUSMA is an important risk to our projection. I mean, what we have built into our projection is that tariffs that are currently in place remain in place. So what that means is that the tariffs on the hard hit sectors stay, the CUSMA exemptions for everything else remain in place. That could change with the review. The other thing we have in our projection is, the uncertainty is already having an impact on the economy. That's built into our projection. We have that gradually diminishing over time. But yes, CUSMA is under review, and the outcome of that, there's obvious risks to the projection. The outcome may not be no change, and we highlighted that in the press release, and in the back of the monetary policy report. We go through a number of possible outcomes for CUSMA. I would stress that we've done a number of scenarios. They've been in our monetary policy report. We've published them in speeches as well, with a whole range of different configurations of U.S. tariffs. We've found those useful in our decision making, and I think it's never easy to manage uncertainty, but I think they do help us think through the channels and some quantification of the impacts of different CUSMA outcomes.
All right, we will go to Kevin Carmichael from The Logic next, please.
Good morning. Governor, in your statement, you talked about how the Governing Council sees the potential for some reallocation of capital and workers as new opportunities open up. What do you mean by that? What do you see there? What do you see happening?
Well, I think you're right. There's a lot packed into that. You've got a number of very hard hit sectors in Canada: steel, aluminum, lumber, auto industry. They clearly are looking for new opportunities to provide for the Canadian market. When you start to look at things like steel and aluminum, you quickly learn that, well, there's actually a lot of different products, and they may need to pivot to new markets, whether those are in Canada or outside of Canada, and that could involve some restructuring. They'll need some new capital. They may need some new skills. I think more broadly, whether you've been hit by tariffs or not, the U.S. the relationship with our trade relationship with the United States is fundamentally changed, and what you're seeing is that businesses, even if they are CUSMA compliant and are exporting to the United States, they're looking for new markets, new suppliers. The government, the Prime Minister, has been traveling around the world looking to open up new opportunities for trade and investment in Canada. Businesses are looking for those new opportunities. So, it's a combination of all those things, including opening up and reducing the trade restrictions within our country to grow the internal market, diversifying to others, and then reallocating capital and in some cases jobs to seize those new opportunities. And I guess what I would stress is that that is going to take some time. That is not something that happens quickly. And through that transition, it does lower the economy's potential growth. As that adjustment, advances, productivity growth should come back up. The economy should be stronger. There should be more resilient. That is going to take some time, and we have a 2-year projection. it's happening through that whole 2 years.
Okay, next let's go to Promit Mukherjee from Thomson Reuters, please.
Governor, between October and now, what has changed that has made you say that the range of possible outcomes are wider than usual?
Well, I mean, I think there's a few things. I think there's a sense that geopolitical risks are heightened. I'm not going to go through every event, but the month of January has been pretty packed with new elements, new geopolitical risks. I think U.S. Trade policy. There was through the last spring. There was some very big changes, some pauses, some reintroductions, some deals. Through the summer, I don't want to say uncertainty was low, but you saw a little more stability. I think recently you've seen more unpredictability in U.S. policy with all sorts of threats, including on Canada. U.S. trade policy remains highly unpredictable. And then I think, CUSMA is coming more into focus. It's now 2026. It is under review this year. So those are really the key elements that have increased uncertainty.
All right, let's stay on this side of the room. Next, I'm going to go to Craig Lord from Canadian Press, please.
Hi, governors. Thanks for taking our questions. You've spoken alongside other central bankers in support of Jerome Powell in the United States, and I'm curious if there are implications for monetary policy in Canada if you lose confidence in central bank independence in the United States.
Well, to get back to the previous question, yes, I think the threat to independence of the central bank in the United States is one thing that has sort of been contributing to this sense of uncertainty. Look, why did I make a point of commenting on Chairman Powell and the U.S. Fed? Look, the simple reason is the U.S. Federal Reserve is the biggest, most important central bank in the world. And we all need it to work well. A loss of independence of the Fed would affect us all. And for Canada, our financial markets are particularly integrated with the United States, so it would particularly affect us. It's hard to predict exactly what this would look like, but keeping the Fed operating independently, it's good for Americans, it's good for Canadians. And let me just expand a little bit on that. It's not independence for independence sake. What does independence do? It provides central banks with the space to take difficult decisions that benefit the economy, benefit the citizens of that country over the medium term. The historical record is very clear. Central banks with operational independence for monetary policy do a better job of delivering price stability for their citizens. Under Chairman Powell's leadership, the Fed, he is doing a good job at leading the Fed based on evidence, based on facts, based on best economic judgments of the FOMC. I hope it stays that way. That's going to be important for everyone.
All right, let's now go to Greg Quinn from Market News, please.
Good morning. The revised forecast here mentions that the U.S. is putting in some robust growth this year, and inflation is high, but it's moderating. So, in a sense, is Donald Trump being vindicated about tariffs? Do they, in fact, not do much damage to the American economy, at least?
The bottom line is it's too early to tell, Greg. Just as it's too early to tell in our economy, these things feed through gradually. I think particularly over the last year, I think businesses, both in the U.S. and outside the U.S., I think we were all surprised by the initial announcements of U.S. trade policy. And I think there's been a period of time where businesses are waiting to see what actually shakes out. And the constant changes, the constant announcements, the threats, the rollbacks. I mean, if you're a business, you're kind of waiting to see where things level out. So I think you're going to need to wait to see what the long-term impact of these policies are. You've also got other things going on in the U.S. that are affecting the economy. There's this big investment in AI that's driving a lot of growth. So you kind of have to separate what's driving the growth and what might be holding it back. So.
All right, let's go now to Eric Hertzberg, please, from Bloomberg.
Hey, good morning. Can you guys give us an update on how you view the rollover risk for mortgages for Canadian households, given the recent uptick in terms of longer-term rates? How do you view that at this point?
I mean, I don't think we've got a big change in the comments we've given you in the past on this, Eric. I mean, this is a big year for mortgage rollovers. I think it's the biggest year in decades in terms of the number of mortgages that are rolling over. We do expect those rollovers to see payment increases, in large part because a lot of them were taken out in a very low rate environment. The recent sort of uptick in the yield curve will maybe marginally add to that payment increase, but most mortgagors have been preparing for this payment increase for a long time. The fact that rates have come down has meant those payment increases will be smaller, but we'll continue to watch it.
All right, next I'm going to call on Jordan Gowling from the Financial Post, please.
Good morning. You said the effort to diversify trade and integrate internal trade will, quote, support some recovery in our productive capacity. Is that an acknowledgement that the diversification push away from the U.S. will only partially offset the trade war impacts?
Yeah, I think you basically got it. I mean, if you look at the, we published these charts several times. Sort of here's the Canadian outlook without tariffs. Here's with U.S. tariffs, and you see, the reality is there's more trade friction. The economy works less efficiently, and that puts the economy on a permanently lower path. Now, you can, on that, yes, it's lower, but how much lower it is going to depend on your restructure, how much you restructure. As you adapt, as you diversify your trade, as you develop new markets, as you could certainly, I mean, there's estimates that suggest that you could offset the U.S. tariffs if we completely opened our internal trade. So there are things you can do that, we'll see exactly where we end up. But, it's pretty clear that, the days of open rules-based trade with the United States are over. We need to get on and adjust to that. We'll be better off if we adjust than if we don't. But, I mean, clearly we're, the end of open rules-based trade with the United States is not a good thing. It's not a good thing for Americans. It's not a good thing for Canadians.
All right, let's go to Mark Rendell from the Globe and Mail, please.
Thanks for taking the question. I'm wondering, in terms of the U.S. dollar right now, what's happening there? Obviously, there's been significant weakness in USD recently. I'm wondering, first of all, what you think is driving that. Secondly, are you concerned at all at a moment of export weakness that the Canadian dollar is appreciating against the U.S. dollar? And is that something the bank would ever lean against?
Well, look, I mean, first question. First part of the answer, Mark, is as you're well aware, we don't target the Canadian exchange rate. The flexible exchange rate is an integral part of our inflation inflation targeting regime. So yes, the Canadian dollar will fluctuate. Actually, if you go back sort of for the whole period since October, Canadian dollar has been pretty stable around relative to US dollar at about 72 cents. Yeah, in the last couple of weeks, you've seen some renewed US dollar weakness, and so many currencies, including the Canadian dollar, are appreciating somewhat against the US dollar. What's driving that? I think it's largely geopolitical events, and that's really been, whether it's trade or other geopolitical events. If you go back over the past year, where you've seen movements in the Canadian dollar, in particular where you've seen movements in the US dollar, it has largely been driven by trade or geopolitical events. They're not being driven very much by commodity prices, interest rate differentials, the sort of normal types of things that more normal types of things that would drive the exchange rate. Look, I mean, I think the only thing, it's hard to comment on near-term volatility. We'll see what happens. I will say more broadly, the U.S. dollar has depreciated over last year by about 10%, and I think what you're seeing is that international investors, they still want exposure to U.S. equities. U.S. equity market's been strong, but that safe haven role of the U.S. dollar has been dented. People don't want as much exposure to the U.S. dollar. They're hedging more of that. That is being reflected in the value of the U.S. dollar. And at the same time, you're seeing other safe havens, most notably gold, up a lot. But what happens next?
Okay, we've got one more question here in the room before I go to the phone. News. Go ahead, please, Mackenzie.
Hi there. In the economic activity section of the NPR, you say that GDP grew by 1.7% in 2025, essentially flat on a per-person basis. Are you saying that basically immigration has been able to prop the Canadian economy up? And broadly, in terms of the cuts that we've seen in immigration, how do you view that filtering its way through the economy?
Well, if you have more people coming into your economy, you have more workers and you have more consumers. So that'll grow your economy. If you slow immigration, you've got less new consumers coming in and less new workers. And so, yes, we are seeing the impact of that. It does mean a lower potential growth. It means sort of the run rate the economy can grow without causing inflation is lower. If you look at our projection, actually we have very low population growth over the projection. And potential growth is about 1%, so it's mostly productivity. You do see some, what that means is what's increasing consumption is mostly increases in consumption per person. So it's not being driven by adding consumers, it's being driven by each person's consumption going up on average.
Okay, we're going to go to the phone lines now, and those reporters who have joined us remotely, I'll just remind you folks, please, to come off mute only to ask your question and then go back on mute as soon as you're done. That way, everybody will be able to hear the response. I got 4 folks on the line. I'm going to start first with John McFarland from Yahoo Finance before going to Anna Pereira from The Star. So, John, to you first, please.
Hi, thanks for taking my question. You described the uncertainty as heightened and the range of outcomes as wider than usual. So practically speaking, does this elevated uncertainty create a higher hurdle for moving rates in either direction? Or does it suggest you might need to react more aggressively or earlier if data breaks one way or the other?
Well, let me just say a few words perhaps about our Governing Council deliberations, how we're thinking about it. We did discuss the future path of interest rates in our deliberations. And, bottom line is we agreed that the current policy rate is appropriate if the economy evolves broadly in line with the outlook we just published. But we also recognized that, yeah, as you just said, uncertainty is heightened. It's unusually high. There's a broader range of possible outcomes. And so against that background, as we discussed it, the clear consensus was it's very difficult to predict either the direction or the timing of next move in our policy rate. To put it a bit more technically, in order to assign probabilities as to the direction of the next move in the interest rate, you need to be able to assign probabilities to the risks. And I think the way we were feeling is given high uncertainty, that's difficult. So I think that the real takeaway is, yes, uncertainty is high. We are monitoring those risks very closely. And if a new shock comes along or an accumulation of evidence that materially changes our outlook, we're prepared to respond. So, we are very alive to those risks, but we need to see. If something crystallizes, we'll assess the implications for the projection, and then, yes, we'll be considering what the monetary policy implications are.
Okay, we'll go to Anna next, followed by Max Sato from Mace News. Anna?
Hi, good morning. My question is also about uncertainty. So you keep repeating it's too early to tell how well the economy will adjust to uncertainty. But, we've been living under these conditions for a while now. You have 1 year's worth of business and consumer surveys showing how people have been responding to uncertainty and tariffs. I was hoping you could characterize the level of uncertainty for us. Would you say it's higher than it was a year ago?
Well, it's hard to parse exactly every moment in time, but it's high. And I think I've gone through in a fair amount of detail what the various sources of uncertainty are. I do think, though, that it is important to sort of step back from the kind of daily noise. Some things are clear. It's clear that the era of open rules-based trade with the United States is over. It's clear that our population growth has come down and is going to stay lower. It's clear that new technologies, particularly rapid advances in AI, have the potential to have a significant impact on businesses, on the economy. And whether you're a business trying to chart the way forward or you're a policymaker, those things are clear. The Canadian economy needs to adjust to those things. We think that has started. We think it's going to take some time, and through that period, growth will be modest. If we do adjust, the more we adjust, the stronger the economy can be, the more resilient the economy can be going forward. Central bank is not at the center of that. We can't. We're not at the center of that, but we can play a supporting role. And as we consider our monetary policy deliberations, we're basically trying to provide some support to the economy to help it through this transition, while making sure that we maintain inflation close to the 2% target.
All right, we'll go to Max next before wrapping up with Rob McClister. Max?
Thank you, Paul. Good morning, Governor. In your outlook, the positive contribution of consumption to GDP for the next 2 years is weak, while the net export contribution seems to pick up this year and improve substantially in 2027. So what are the main drivers behind those changes in consumption and net exports, including expected weaker imports, and what new export markets do you expect to see? If you can give us some examples, like by country, by goods and services, and if you can think of any risk to outlook that you might have left out or didn't discuss much in the NPR and your opening remarks. Thank you.
Those are three questions.
I can let the Senior Deputy Governor talk about everything I left out.
Well, I mean, just going back to the last couple of questions about uncertainty, I mean, I think that's one of the reasons why we feel uncertainty is elevated just when we think we've thought of everything that could possibly hit us, something new happens. So, I mean, the uncertainty is there around U.S. trade policy, and then more recently it's been around U.S. foreign policy. So, I mean, the reason something's a risk is because you haven't thought of it. So there very well could be things we haven't thought of inside that already sense of elevated uncertainty. Do you want to take the question?
Well,
on
I mean, in terms
contributions,
of if you look at exports, the level of exports, at first they went up a lot as businesses tried to get ahead of the tariffs. Then they've subsequently gone down. And if you go back to before they went up, they're down about 4%. Going forward, we've now got them, returning to some modest growth, but they're growing along that path that's, roughly 4% lower. We have seen some adjustment. Companies, you see this both on imports and exports. We're importing less from the United States. We've found other suppliers, companies have, and we're exporting more to other countries. And I think there's a chart somewhere in the NPR that shows that our exports to other countries have gone up. Now, 75% of our trade historically has gone to the United States. So, it takes a lot of growth of other countries to fill in for the big drop we've had with the United States. So it's only providing some partial offset. When we talk to companies, what we hear is that so far it's not so much about finding whole new markets. It's more about discussing with the clients they already have and exporting more to those clients. There is certainly the potential going forward to actually develop new markets, and that is part of that structural adjustment. On business investment, it's certainly being held back by all this uncertainty. If you're a business leader, it is very hard to decide how to allocate your capital against this background of uncertainty. Having said that, I think companies increasingly are seeing that the days of open trade with the United States are over. They are starting to adjust. And as they do, that will be reflected in their business investment decisions. Governments have also increased their infrastructure investment, and they've also introduced a number of incentives to incentivize business investment, and particularly to help companies that need to pivot. So those things all together, we think with some recovery in exports, combined with government incentives, we expect to see some pickup in investment, but it does take some time.
Okay, and we'll wrap it up.
Just to clarify, the weaker imports is because of weaker demand here? Or?
Well, there's a bunch of factors. Part of it is, most countries export or import with the United States. Canada and U.S., we build stuff together. So when we export less, that means we also import less because there's less stuff going back and forth across the border. That's part of it. Part of it is diversion. Some goods that we import from other countries traditionally have come through the United States. So goods coming from China might come through the port of LA and then up to Canada. That was the most efficient transportation route. But now that those Chinese goods are hitting a big tariff at the U.S. border, it makes more sense for them to come directly to Canada. So that shows up as less imports, even though the original source was China. That shows up as less imports into Canada. And then part of it is companies just want to find more reliable suppliers. They're looking to, they don't like dealing with trade uncertainty. They're looking for suppliers they can be more confident in going forward. So it's hard to separate all those things, but there's quite a few things affecting imports.
Okay, and we will now go to our final question, and that's from Rob McClister. Please go ahead.
Good morning. You mentioned that an independent Fed is good for Canadians. Is that because it would likely keep U.S. inflation lower and therefore indirectly help keep Canadian inflation lower, and other things equal? How should Canadian borrowers expect our monetary policy to be impacted in the case where concerns over U.S. inflation deficits, Fed independence, and so on start driving up American rates?
I think I've done my best to answer that question, so I can ask the Senior Deputy Governor to take it.
I mean, the answer to all of those things is those things factor in. I mean, as the governor said, the bottom line is a strong Fed benefits pretty well every other economy in the world, but most definitely it benefits our economy. A strong Fed keeps the market stable, it keeps inflation stable, and all of those things contribute to predictability and less sort of volatility in rates, just as you said. So yeah, it's there's a lot of reasons for having a strong independent Fed.
And that'll do it for today's press conference. Thank you, Governor Macklem, Senior Deputy Governor Rogers. Thank you all for joining us and for tuning in today. We will see
you. That's the news conference by the Bank of Canada Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers. And one remark that the governor made, already creating an international headline. You'll recall that he said the days of rule-based trade with the Americans are over. And that headline being relayed right now by Agence France Presse. It's not a completely new idea, but Tiff Macklem was pretty clear that echoing the Prime Minister's comments that we're into a new era. Remember, the Prime Minister said that hegemons, powerful nations, and of course, America will be one of them, although he didn't name the USA, have been using tariffs as a pressure tactic on mid-sized nations. And other remarks by Mr. Macklem, the Bank of Canada governor. He was asked, why did you make a point of expressing support for Jay Powell, the head of the Fed? And he says, we all do better if central banks are independent, especially the U.S. central bank, which is the biggest, of course. It was an interesting question there. They were asked, has Mr. Trump been vindicated on tariffs because the U.S. growth has been strong, the deficit has come down? But Carolyn Rogers fudging that question. It's too early to tell. Anyway, let's get more from Stuart Paul, economist, a US and Canada economist at Bloomberg Economics. Thank you very much indeed for joining us, Stuart. First off, anything jump out for you with the tone or the information conveyed in the press conference?
Well, what really stood out to me was in the monetary policy report, and the entire report basically emphasized a low growth regime. What was forecast for 2026 is just a 1.1% headline real GDP growth rate, but the forecast and the estimate for potential growth was revised up since October. So on a relative basis, there's a bit more slack estimated for the Canadian economy in 2026. Looking ahead to 2027, potential GDP growth was revised down in part because of the reshuffling of the global commercial order, trade, as you say, and slower population growth. So all things considered, even though growth surprised to the upside in Q3, basically zero growth in Q4, more slack in 2026, and slower potential growth in 2027 are all reasons for the BOC to continue providing accommodation, certainly through 2026.
Now, Stuart, correct me if I'm wrong, but you're not looking for more, you don't expect more rate cuts by the Bank of Canada?
I don't. I think that we've already reached this terminal rate at 2.25%. By my estimates, policy is already about 50 basis points accommodative. So relative to what we would prescribe using a formulation of a Taylor rule, we think that the current 2.25 policy rate is already about 50 basis points accommodative, with fiscal policy also supporting growth and most of the growth headwinds coming from factors beyond the control of monetary policy. We expect the BOC to basically stay where they are, maybe with a hike at year end in December. So I was actually just surprised to hear Governor Macklem say that the direction of monetary policy from here on is uncertain. I think that the direction is going to be towards a hike, but late this year, very late this year.
a lot of people still think that we're going to get one or maybe two cuts. So you're a bit of an outlier there, I think.
Yeah, look, it all depends on where you think policy is neutral. And I think that the neutral rate is closer to 2.75%. So the BOC already has its foot a bit on the gas, providing support. I also am very optimistic about USMCA renegotiations. I expect that it's actually going to be pretty swift and a deal is going to be achieved just in the third quarter of this year. And once that's the case, all of the uncertainty that was discussed during the press conference, all of the uncertainty commented on in the monetary policy report goes away, and firms can start investing again in the second half of this year. And so the BOC can move back towards neutral, which I think is up from here.
Stuart, always great hearing from you. Thank you very much indeed. Really appreciate it. Stuart Paul, US and Canada economist at Bloomberg Economics. That wraps up this bonus edition or bumper edition of The Open. Morning Markets is up next.